Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day, and we're counting down to the next VRIC, January 21st and 22nd. There is a link in the description below where you can get your tickets. And today's guest is the executive producer of the Gold Forecast, a columnist for Kitco with over 40 years of experience as a technical market analyst. It's Mr. Gary Wagner. Thank you for coming back on the show.
Pleasure to be here. Thanks very much for having me.
Well, let's start with what appears to be weakness in the US dollar. How significant do you think this recent drop in the dollar is, and what are the drivers behind it?
Well, yeah, I look at the big spectrum, and when you go back a few years, well, first let's set this question up. When we talk about dollar strength or weakness, we're not talking about buying power. How much does a loaf of bread cost, and is it costing less or more? Because that has been shrinking consistently since we went off the gold standard. What we're talking about is the relationship of the dollar to a basket of currencies that are weighted. So for example, there's 6 currencies, but the euro is almost 60% of that weighted scale. And you've got the Swiss in there, the British pound, and other ones. So when we're looking at dollar strength or weakness, we're comparing it against European economies for the most part. And so we want to look at it in that standpoint, not think that what we're talking about is buying power of the dollar. The dollar was sitting a few years ago back at about 90 on the dollar index. And back in about 2020, it went from about 90 and ran all the way up to 114. And then from 114, and that happened, I'm looking up at my chart, that was November of last year. And from there, it fell, and it fell to a low just below 100 recently. First, I think the dollar has bottomed. We were looking at it being very top heavy. Even when it was sitting around 105 and 106, it dropped to roughly 100, and I believe it's going to move back up. What these moves are based on are a couple of things. Primarily, what we're looking at is the attractiveness of government yields, US debt instruments, compared to European bank debt instruments. In other words, if you're looking at a fixed income, you're a global investor, you're going to always be looking at where you can get the best yield, because the euro is not going to belly up and the United States is not going to belly up. So they're very secure investments, fixed income. And if you just think back a couple of years ago, if you went to a bank and you got 0.25% or 0.5% from a CD, you were going, well, I'm not getting anything, but that's what I'm going to expect. Now they're yielding 4 and 5%. The same with the bonds and the notes. In fact, the notes climbed up to nearly 6.5%, the short-term notes. That happened as they were getting ready to raise the debt ceiling because there was worry that they wouldn't go through with it. But the primary reason is attractiveness of government debt instruments, bonds, bills, and notes. And what's happened is, as the Federal Reserve has been on this rampage to stomp out inflation, they've raised rates at starting in March 2022, the 10 next consecutive FOMC meetings, beginning with 0.25%, 0.5%, all the way up to 0.75% for a couple of times, and back to 0.25%. We had our first pause, the 11th FOMC meeting, took a pause, and then we're getting ready for a meeting next week. And that's another question, so we'll talk about how we feel about that. But it has to do really with the yields of government instruments when you compare what the United States bonds are yielding as compared to other ones. The other thing that you want to look at is the GDP of a country. How strong is the economic growth? And so the reason that the dollar has been strong historically is that in terms of industry, we're really an economic powerhouse. That's why we're considered a superpower. And so when you have something that's really running on 8 cylinders, so to speak, and it's got a good yield, it will attract foreign investors. And what happens is, as people go and buy more bonds, the dollar goes up. Now, we've seen it fall, and we've seen it fall because of a thing that's simply called market sentiment. In other words, why have you seen gold rise recently and the dollar fall recently is not on anything that's happened yet, but it's on the hope or the expectations that the Fed is going to pivot from being really aggressive and raising rates more and more to either pausing and at some point cutting. And so they're betting on 6 months out in the future, 8 months out in the future. So you'll see yields rise and fall based upon the perception of what's going to happen. And the same thing goes on in the stock market. You're not buying a stock based on book value, because if you did, prices wouldn't change a lot. You buy a stock or a commodity based on where you think it's going to be 6 or 8 months down the road. And so that's what you're seeing.
Well, let's talk about gold. I definitely want to get to your thoughts on the Fed and what you see them doing up ahead. But before we do, obviously, you have a great video newsletter service called the Gold Forecast where you discuss gold. So, what are you seeing recently? A lot of people are talking about gold potentially reaching all-time highs this year. Is that a possibility in your view?
Well, I think most likely we've seen our all-time high this year, the highest value it's going to reach, which was just a few dollars away from $2,100 per ounce. My initial forecast, I was looking for 22 to 2,300 this year. I missed it by about $100. We could see it move up if the Fed does certain things that I personally don't see happening. And that would be to start cutting rates. Or if inflation continues to rise, they use their tools and inflation stays really persistent and keeps ratcheting up. See, what has been happening with gold is higher interest rates place a tremendous amount of bearish market sentiment towards gold, because when you can get 5% guaranteed against a non-interest yielding asset, the gold doesn't produce anything. It's not a company. There's not a product. And so if you're looking for a guaranteed yield and that yield's respectable, 5%, it makes gold less attractive. On the other hand, inflation, well, gold's always been considered a hedge against inflation. It still is, but it's a very tight correlation with a very long lag. But what happens is gold tends to have the same buying power it always had. The price reflects, unlike the dollar, the price of an ounce of gold reflects what you can buy with that, what value you can get for it. So for example, and I use this story a lot at lectures, and that is back in the 1900s, if you had a $20 bill, which was a gold certificate, or a $20 coin, you could go to New York for the weekend. You could buy a really nice suit. And this is with $20. You could get a room, not a suite, but a room at the plaza, and have a good steak dinner. And you could do that all for a $20 bill or a $20 gold piece, 1910, 1913. Now, let's take it forward, 100 plus years, and that $20 bill won't buy you even the steak dinner. It might buy you a couple of cups of Starbucks coffee and a bagel or something, but it's certainly not going to buy you anything at the plaza, and you're not going to be able to get a suit, because back during the 1900s, a suit literally costs about $10. A suite at the plaza was $8 a night. A steak dinner was $1.50. Okay, so now let's move forward. You can't get anything with that $20 bill, but if you have a gold coin, and gold is worth about $1,900 per ounce, you can get a decent suit for $1,000. You can get a room at the plaza for maybe $600 a night, not a big room or a nice room, but right around there. And you can get a steak dinner for $150. And if you add all of that up, that ounce of gold basically has the same value now that it did a couple hundred years ago. And so when you're looking at gold relative to inflation, it tends to keep up with inflation. And the best way to think about it is what you're able to buy with that ounce of gold. And from that example, you can see that over a period of over 100 years, your buying power has been really very much the same. Now, it was that way with the dollar through World War II. Bretton Woods changed that a little bit because that's when they first modified it. Of course, Roosevelt confiscated all the gold in the 30s, but Nixon put the last nail in the coffin, so to speak, when he completely took us off the gold standard. And that's when the buying power of the dollar just shriveled to nothing. So those are just some motivators in terms of why people like gold. But what I think right now is the recent move that we've seen, which is it ran down to about 1900 and 1900 recently, and then it's moved up. It's moved up on the hope that the Federal Reserve will begin a pause in interest rate hikes, because that's what hurts gold.
Let's talk about silver as well. How closely correlated is silver with gold? And how do you see silver performing up ahead? Maybe give us a bullish scenario and then maybe any headwinds that you could see creating obstacles for silver.
The one thing that you want to, I've been in the industry for a long time, as you've noted in my introduction, and there used to be a very, very tight tandem connection where they both kind of rode this wave together, and you had moves up, they'd be both in gold and silver, and moves down, both in gold and silver. They have decoupled, and they have decoupled over the last few years. Silver still is considered somewhat an inflationary hedge, but it's the industrial use that has grown so much that has put it in its a world of its own. So it's more of an industrial metal right now, precious metal, but industrial metal nonetheless. It's used for solar. It's used for so much of the green technology and so much in electronics. And so I look at it as, when I compare gold to silver in terms of the potential to profit from it as a speculator, I think that silver is a candle burning at both ends. It burns twice as bright, but for half as long. So when gold and silver are both moving up, you might see gold move up 1%, and you'll see silver move 3 or 4%. Reciprocally, during periods of correction where they're both moving in tandem, silver will outperform on the way up in terms of percentage gains, and it will outperform on the way down in terms of a percentage drawdown. So I look at it in that way. I believe that silver has better upside performance in terms of potential gains simply because of that. The caveat, of course, is during periods of decline, they're much more severe, they're much harder to anticipate, and a lot more brutal in terms of how much you can see it lose in a given trading day.
Let's take a moment and touch on trading versus investing and the importance of time horizon. So firstly, tell us the time frame that you approach the gold and silver trade from. Are you doing more shorter term trades? Are you also taking long positions? How do you approach the space in terms of time horizon?
You have to be sensitive to the market itself. You can't dictate whether or not you're going to always be a trend trader. My belief is, and I take this from mentors of mine as well as idols of mine that I watched trade back when I was just coming up in the industry. And although I don't genuinely always agree with his politics, there's a gentleman named George Soros who has amassed billions of dollars as a commodity trader. And his philosophy was follow the trend, find a market that has a long-term trend and ride it. And I've always wanted to be, and am to this day, a trend trader. Although, to give you an example, between 2009 up to the middle of 2011, I watched gold go from basically 700 up to 1900. Now, that was a trend we took advantage of and made a lot of money. However, then it dropped like a rock. And then for 3 years, it traded between 1536 and 1800. So it began to trade within a defined range. When it's in a defined range, if you're bright enough to be aware of that, and I've gotten caught not being bright enough to be aware of it because I got caught up in the momentum of what I just saw, you have to then be not so much a swing trader, but a short-term position trader. A swing trader tries to buy the bottom and then go short on the top. A short-term position trader simply tries to buy the dip or always looks to sell the top, but not catch both ends. You have to be aware of what a market does. Typically, when I was first introduced to the industry, you looked at things like lumber, cattle, meat products, as well as grains to a certain degree, as always staying within a channel. So there were highs and lows, and they were based on when the animals were born, how long it took to get them to a weight, to take them to actually get turned into meat. And so, of course, when they're harvesting animals, so to speak, it's a terrible way to put it, but that will bring the price down because there's a lot of that on the market. In fact, I had an IB when I was younger, and the first FCM I work with, which is a futures clearing merchant. First, you can be a broker. Then if you own a brokerage firm, you're called an introducing broker, an IB. But you have to clear your trades through a futures clearing merchant. And this one was Saul Stone. They've now turned into StoneX, and they're one of the largest in the world. But they owned all of the cold storage units in Chicago that had bacon slabs, pork bellies. So they pretty much controlled the market. And if they had massive long positions in house, they simply didn't release them. And so they could affect the market by holding back product and making the price go up because there was more demand than supply. It always comes down to supply and demand. And so you want to be, depending on the market you're trading in, you want to be cognizant of what you're doing. I know one of the questions is going to be about trading later, and we can go into more detail, but always trade something that you know, that you're comfortable with. If you're an architect and you build homes, look at different housing stocks and builders and things like that, because work with what God has given you as a background, and then use that to affect your trading. But I like to be a trend trader because it has the greatest potential for profit. There is, I believe, less risk. However, when a market is in a tight and narrow trading range, you get chewed up terribly because you're going long anticipating it's going to break out and move, and then it hits, $30 higher and crashes. And that was typically what we were seeing in gold.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Well, let's talk about technical analysis as well for a moment and the benefits of technical analysis. It can often seem obscure and confusing to people, including myself. I only have looked into the very basics of it. And a lot of people they stick to the Ben Graham, the fundamentals of investing, and they don't find use, or at least they don't understand technical analysis. So why should people look into technical analysis? Is it useful for long-term investing as well as short-term trading? And where do you think someone should get started if they want to start looking into it?
Great question. I call myself a hybrid market technician. I follow fundamentals and I'm deeply involved in analysis through technical indicators. So when I first started in the industry, I listened to the news and I would listen on, there was a multitude, as there is now, of financial channels that you could watch. And I'd hear one analyst give a detailed and profound definition as to why he thought gold was moving higher. He would label this and this and this. And at the end of his 5-minute interview, I said, gold is going up. I'd switch the channel, another analyst would come on and he'd give me a profound, elegant, articulate reason why gold is going down. And then I said, you know what? Gold is going down. In other words, fundamental analysis can be interpreted in many ways. So it's not an exact science, but the most important thing to understand is that the reason a market moves is based upon news events, fundamental events. That's the core of it. Because a stock or commodity is above or below a moving average, we'll talk about that in a second, doesn't mean it's going up or down. The reason I switched from only looking at fundamentals to moving to technical analysis is once I was exposed to it, I realized that this is based on numbers and math, and people can spin tails, but numbers are clear. There's no gray area. It's black or it's white, and it gives you a truth that you can't get from people expounding their opinions. And I realized it was much more clear cut. I believe that everyone should incorporate fundamentals, get a sense for what's going on and how that could affect the market, understand the economics behind what you're looking at in terms of your investment. If you're in real estate, why is real estate going up or why is it going down? Well, when we look at it, it's pretty easy. Right now, you've got a scenario where you could get a mortgage for 2 and 3% a couple of years ago, and now the mortgages are at 6%. So what's going to happen to the housing market? It's going to be much more difficult to buy a property. You're going to be priced out of what you could have bought before, and you're going to pay a lot more money in interest than you did. So it's going to definitely change your perspective. So that's the fundamentals behind it. And that is the most important part. But how do I make sense of that? Because what is happening is investors are not buying or selling a stock or commodity based on what it's priced at now. It's based on their perception, market sentiment, their perception of where it's going to be 6 months down the road. And for that, technical analysis is a really, really good tool. For someone who's getting started in it, I would recommend starting with some simple philosophies, simple ideas. There's so much information on the internet. You don't even need to spend money. You just need to devote time. Look at a thing called moving averages. Everyone knows what an average is. You take 10 numbers, you multiply it and you divide by 10, and there's your average. So a market technician in stocks, for example, will use a 50-day, 100 and 200-day moving average. And the short-term moving average, the 50-day, if it's trading above that 50-day, it is in a short-term uptrend. Above 100-day, it is in an interim term uptrend, and 200-day, it is a long-term uptrend. Now, as a technical trader, I used to use 3, 7, and 13-minute averages for my short-term trades when I was young, and anything longer I didn't have the patience for. But so, for example, if you look at a chart, you want to get an idea, is it going up or going down? And sometimes if it's a weekly or a quarterly or monthly chart, it's easy to see that defined trend. But as you magnify that and go to dailies or intraday charts, it becomes more of a wash. It's hard to see the forest from the trees. So take a daily chart, put up a 50-day moving average. If it's been oscillating in between that 50, you know it's trading sideways. There's no trend that has developed. If you see something that's moving away from the 50-day and it's moving above it, that means that that trend is strengthening. That's the number one thing. MACD, moving average convergence divergence, is a fancy way of saying take two moving averages of a different cycle and see if they're moving together or moving apart, which is basically the same thing I said to look at price action, whether it's moving away above an average or if it's moving below an average. Okay, those are two that I find I use them all the time. Now, I also use candlesticks, Japanese candlesticks. In fact, I wrote my first book in 1993 on candlesticks, and I'm considered to be one of the foremost experts on candlesticks, at least in America, definitely not in the world. There's a book by Seiko Shimuzi called The Japanese Chart of Charts. It's where I gained all of my insight. And Steve Nissan, who is a gentleman that I know, was the first person to read that book and then translate those ideas into English. And that was in the 90s, because I remember seeing these funny looking charts on my charting system as a broker, not knowing what they meant. Take the time to understand not only how they visually represent price movement over time, they give you a much clearer visual imprint of what's happening. But what they were able to do is not only are there candlestick types, but a thing called Japanese candlestick patterns. So they might be 3 different candlesticks that are in a certain configuration. And this is going to be a short sentence, but if you think it through, you're going to realize the brilliance. I mean, they were developed back in the 1600s, and yet today they still have a profound way of giving you insight on the market. But what Japanese candlestick patterns can do is they are a technique that has mathematically quantified market sentiment. There's nothing in the world that mathematically quantifies market sentiment. In other words, they put a number next to how people feel. Feelings and numbers are not the same. Feelings are hard to talk about, but numbers are cut and dry. Again, that fundamental analysis versus technical. They were able to realize that if a market is an uptrend, and most people have a rudimentary understanding, it's just that you draw a rectangle around the open and closing price. And then there's a wick on top and on the bottom, which represents the high and the low. The reason they put a rectangle rather than a bar chart, which just simply puts a horizontal line, is they believe that every day during a trading session, it's a battle. And the battle is between the bullish faction and the bearish faction. And the color of the candlestick simply allows you to quickly see who was victorious on that day, because they look at it as a battle. So if it opens and closes higher, I draw it in green. If it opens, closes lower, I draw it in red. It used to be white and black, obviously, when they were just putting it on paper. And so if a market is in an uptrend and it has a long green candle, that means it's really continuing to move higher. The following day, it opens above the closing price, so it gaps above, but then it trades during the day, goes into the boundary of the prior day, and then closes at or below the midpoint of the day. It's called a dark cloud cover. And if it's followed the next day by a red candle with a lower low and a lower high and a large red candle, it tells you that there's a high probability that the market hit a top and it's going to start coming down. So they were able to identify certain patterns, certain group types that could tell you if a market was trending, if a market is getting ready to pivot, if the market's trading sideways. And so if you combine that with listening to the news and fundamental analysis, and you put that all together, you're ahead of the game, because that will give you an edge, and it will allow you to see the market clearer and understand the possibilities better than if you're just listening to fundamentals or just doing TA, just technical analysis and disregarding the news behind it, because numbers don't move the market, people do. News events do. So combining both of them is my advice. Everyone should incorporate at least a little bit of technical analysis. Start small, look at moving averages, and use the basic rule of thumb to just determine if it's in a trend. Especially if you want to be a trend trader, you want to see if it's got a consistent move above and it's widening. You know there's some more room to the upside. If it's going back and forth between that, that's where you want to be a short-term swing trader, because it doesn't have a lot of room to the upside or to the downside. And the likelihood is it's going to have a range of X, whatever X is. And so by seeing it oscillating, that's a perfect place to be a short-term swing trader. If it's trending, you're just going to see price moving away from an average and gaining more distance. And so then what you want to do is, if you have a little bit of knowledge of candlesticks and the primary patterns, there's maybe 20 of them, and you see those patterns appear, that's when you want to be careful and think, well, maybe it's time, if I'm long this or something, maybe I should pull some profits, take half of the position off, or raise my stop, however you're working with it.
That was a very thorough explanation. And yeah, that's where I've started, is moving averages and candlesticks as well. So good to know I'm on the right track. And that gave me a lot of food for thought to keep looking into it. So thank you for that. Let's move on to the Fed and your forecast there, because expectations seem to be for one or two more 25 basis point rate hikes this year. You have some in the camp of saying something's going to break due to this unprecedented rapid rise in rates, and that will force the Fed to pivot and start cutting rates maybe later this year. How do you think things are going to play out?
If you would have asked me a week ago, you would have gotten a very different answer. A week ago, I would have said, look, they've come out, they've been pretty true to their word. People didn't believe them, but they said, we're going to keep raising rates, and they kept raising rates. They said that we want to get our benchmark or our terminal Fed funds rate to about 5%. And sure enough, they did that. But people kept going, no, they can't. They're going to start cutting rates. And you would see periods where market sentiment was way out of whack with what the Federal Reserve was doing. So finally, there was the famous Jackson Hole speech where the chairman really laid it down and said, look, we're not going to cut rates. We're going to keep raising them. We're not going to let inflation get entrenched. First of all, the Fed made a terrible mistake, and they made it during a time when no one had ever experienced it. We went through a recession that followed a great global catastrophe. And so what happened was inflation started ticking up. In 2020, it was sitting at just about 2%. I believe it was June, but it kept ticking up, then 3%, 4%, their target's 2%. By the time they've made their first rate hike, took interest rates from zero, it was 0 to 0.25% was their charge to other banks. Inflation was sitting at 8%. Had they done it a year earlier, we wouldn't have any of these issues, but they were under the assumption that inflation was transitory and it would work itself out by itself. Part of that was true. The supply chain bottlenecks were transitory. There's nothing they could do, even if they wanted to. That has to work itself out through other things. They don't have any tools that will affect that. But they started too late. They weren't correct in reading the market. And then in December, they came out with a dot plot that pretty much shocked the world. It was that, one, we are going to continue to raise rates. There will be no rate cuts in 2023. We will continue to raise rates all throughout 2023. Maybe in 2024, first or second quarter, we'll pause or begin to cut. And that's what they said. And this was a time that people were looking for them to start cutting. And so they made it clear, and it still took a couple of months for market sentiment to catch up with that. he came out recently and said, we are going to do 2 more rate hikes of 0.25%. And then but before we do that, we're going to implement a pause. That's what happened last month. And he also said when they did the pause, they did 10 consecutive rate hikes. The 11th FOMC meeting, they paused. They said, this is not a signal that we're not raising rates. We need the time to assess the effect that all of these rate hikes have had on inflation, because inflation lags behind the tools they use are raising rates. So it was almost a certainty that there were going to be 2 more 0.25% rate hikes this year, and then they'll begin to pause next year. Now, the tool that myself and I would say 80, 90, 100% of professionals go to is the FedWatch tool put out by the CME. And what they do is they look at futures traders trading debt instruments to get an idea if they think rates are coming down or whatnot. And I have some numbers here. Right now, the CME FedWatch tool, this is as of yesterday, is predicting a 99.8% probability of a 0.25% rate hike this month. That's pretty much certainty. I've never seen the FedWatch tool hit almost 100. But here's what's interesting. It's predicting that the following one in September, there is an 86.4% that they'll leave it alone. November, a 73.8% probability they'll leave it alone. December, a 66.8% probability that they'll leave it alone. What does that say to you? It says that the probability now is that there will be 1 more rate hike this month, and that they will probably pause throughout the end of the year and then gauge what effect it's had, how close they are to 2%. If they need another push to get it to 2%, or if it's naturally going down. They're saying there's not going to be a recession, it'll be a soft landing. I am at odds with that. It's not if there will be a recession, it's they're changing the definition of it, but how hard of a recession it will be, because what are they, by raising rates, their intended outcome is to contract the economy. And what is the definition of a recession? Is a economy that's contracting for a period of time. It used to be 2 consecutive quarters. I believe they changed that recently. But the thing is, the only possible outcome besides lowering inflation is to have GDP go down. That's what they're doing. And so at what point is it going to hurt the economy? The quagmire the Fed is faced with is they've been doing this and the labor market is hot. The economy is kicking out at least 7.5 of 8 cylinders. It's still full blown. My sense was they should have left interest rates at about 3%, left them alone and let the economy just ignite. Realize before the pandemic, we had 12 years of the largest economic global growth in history of mankind, period. It was phenomenal what we were seeing. And that's historically speaking, they're contracting the economy to keep inflation in check. And what's suffering is the GDP has gone down. I think it's supply and demand. If they would have just let it keep going, naturally things would come down, because if there's so much money out there being made and people are wealthy and as a whole are doing well, then that demand stays solid. It matches with supply and prices don't tend to go up in the way that they are. But that's a discussion for another day. My consensus of the Fed is there will be 1 more rate hike this year. You will not see a rate cut this year. Most likely you'll get your first rate cut, depending on where inflation gets to by the end of the year, maybe Q1 24, maybe Q2, but you won't see it this year. That's my opinion. But it's based upon pretty solid numbers from the FedWatch tool, which has been a really astounding indicator to get an idea of what they're going to do, because nobody knows.
Right. Very good analysis. I want to end on the BRICS currency. This is a thing that is making headlines quite a bit in the gold and silver community. The gold market seems to be pricing in the uncertainty surrounding this currency, in that there's been no price response whatsoever. There's questions about, will it be redeemable for gold? Is it going to be backed by only gold or a basket of commodities? Could the BRICS currency be a game changer? Is it destined to fall flat? Is it somewhere in between? What's your view?
My view, you're going to love this answer, is I don't know. Period. I've been wrong on that. I've had times where I've been succinctly right about answering this question because it's such an unknown. At some point, it makes sense that, look, the US dollar has been the dominant currency since the end of World War II. And the whole idea of countries that are now pretty vibrant, you take China and Russia and you put them together, you've got a powerhouse in terms of GDP, especially in China. Their GDP is off the charts, although you can't count those numbers as being totally factual, but that their economy's been rocking. Putin produces a lot of oil. They make a lot of money no matter what they do. And the sanctions set against them because of their actions in Ukraine, they keep kind of chugging along. The idea of there being a currency that is somehow attached to some modified form of a gold standard, to me, is very attractive. Do I think it will take hold? Time will tell. Will it be the demise of the US dollar? When I was asked this about 4 months ago, I said, no, the dollar will always maintain its strength. And then I kind of saw it taking a little foothold, and I kind of wavered off of that and said, well, we'll have to see. And now I come out and I'll just tell you, truly, I can't give you an answer that I feel it's got a high enough probability of being factually correct a year from now to tell our viewers anything. I'm the first to admit if there's something that I don't know, rather than just make something up. It doesn't make sense. I think that there's a possibility that that whole concept will come into fruition in a lot more tangible way. What effect will it have? Will it overtake the dollar? I don't know. I don't think that it will, but I don't know. It's a new concept. Again, I just don't know the ultimate effect that that's going to have, but I like the idea. I just wish the US was the one bringing that idea forth, or the Canadians bringing that idea forth. And I mean, Utah, a state, has produced their own currency that's like a dollar bill has $1 worth of gold in between the paper. I like the idea. I am a gold advocate, and I believe in hard assets. I believe in terms of investment. We touched upon trading and my ideas there. I'd rather end the note with the talk with the idea about accumulation of physical metals and the timeline to do that. Because here I can speak from my experience, right or wrong. It's what I do, it's what I live by, and I'll continue to do it from here infinitum. And that is, I buy gold, I buy silver, I hold gold, I hold silver. When do I sell? I don't. My kids will get it. In other words, I know that if I put a pile of dollar bills and stuff them in a drawer, God willing, in 50 years or 30 years or whenever I'm gone, and they open that drawer and they take out those dollar bills, their buying power is going to be, depending on how much, if I'm lucky enough to live 40 or 30 years, it's going to be much less buying power than it was when I stuffed them in the drawer. And I think that gold especially will have about the same buying power that it did when I put them in the drawer. I believe that everyone should put a percentage of their portfolio into physical accumulation of gold and silver. 1, 2, where do you store it? There's no question. anywhere, you store it nowhere but with yourself. Either a safety deposit box in a bank is fair, or a good safe in your house. Shouldn't say it, but that's where I keep mine. But I do have some in a safety deposit box. Buy it and hold it. Don't speculate with it. Use other parts of your portfolio to speculate with, but look at it like a fixed income. It doesn't produce an income, but I believe that if you look at the price of gold 5 years, 10 years, 20 years out, the same as real estate, it will hold its value or it will be worth more.
Very well said. Well, thank you so much for joining us, Gary. Before I let you go, for those who want to learn more, could you tell us about the gold forecast and your work for Kitco?
Certainly, I started about 14 years ago. Daniela Camboni, like me, asked me to do an interview, and she said, you're pretty good at this. Can we start doing this on a regular basis? They developed a show just for me called Chart This, and then asked me to write a column. It's called After Hours. It's up by 6 o'clock New York time every day, actually Tuesday through Friday. I just decided about 2 months ago, I'm going to go to a 4-day work week. I think at 67, when many people are retired, I'd be bored stiff. I love what I do, but I'd rather have a 3-day weekend now. So from Tuesday through Friday, my article's published there. I have a premium service, thegoldforecast.com. It's all one word, thegoldforecast.com. People can go onto our site, try our premium service for free for 14 days. If they see it has value, if they think it's going to make them a better trader or make them money, whatever they're looking to get out of it, if they feel we've accomplished that, stay with us and pay for it. If not, just send us an email. We make it easy to leave. Send us an email, say, I don't want to continue, and we'll take care of the rest. We don't make it hard to, like a Netflix or something where you got to look for, well, how do I cancel this service? I don't want to take anyone's money if they're not getting value out of it. To search for stuff that we do for free, the Gold Forecast YouTube channel. It's got 2,000 plus videos. You can look at videos that we did 10 years ago when I started my service. You can even look at videos that I did when I first got in the industry in the mid 80s that I would lecture for their, used to be a magazine. I don't know if they're still there, but Futures Magazine. And I did a 2-day learning course for them that they sold the tapes. And so somebody put that on YouTube. So I've embedded that into our website. So you can look at that on the YouTube channel for free. And I did look a little different 35 years ago. But I did have a ponytail. I had a ponytail then, but I recently cut it after 10 years. So times change.
Yeah, well, thank you so much. I will put a link to all of that in the description below for people who want to check it out. Thank you once again, Gary, for coming on the show and sharing your knowledge with our audience.
Always a pleasure. Look forward to doing it again.